Rohr here with an early global view on Tuesday, June 9th, 2015. It is currently 7 a.m. U.S. Central Time. Of course, we've had some very interesting markets the last few days, and they continue to be interesting in the degree to which some of the different asset classes are diverging from the ostensible influence of the fundamental factors. Strong data, but weak equities and stabilizing govies. So what has all this meant to the markets? Well, we're starting typically with our S&P 500 futures. Still June for now. We'll be shifting that over in the next few days, but the liquidity is not quite in September yet until later this week. So we're looking at the hourly on the left, 30-minute on the right as usual. And as you can see, since Friday's employment report, surprisingly enough, this market has broken down through Fibonacci support and the channel at 2106. Now, that might not mean quite so much in terms of the overall activity, because there was also support right into 2100. And as of 2 weeks ago, Tuesday, coming back in from the Monday Memorial Day holiday, that had a buffer down to 2096 that was neared early last week and again on Tuesday. And yet by Thursday of last week, the market was sagging below it, only squeezing back up to recover above 2096 and under pressure since then in spite of this stronger global data. And now sagging below the interim level at 2081, which we've added of late because of this up break and this holding action, but holding, at least overnight, into 2076 for now. This is down $2, right around 2076, which is in the 2078 to 75 support zone. However, it has already traded overnight down as low as 2069, which is another interim level on the way to 2060 to 58, and we'll explore why that's important on the intermediate term picture momentarily. But what we have along the way is, ever since the market weakened late last Thursday, the hourly MACD has been below the lower runaway band. So this encourages weakness in spite of the positive data. And just as a fundamental tie-in on our macro technical view, one would think, well, it's down in part because of the push-up in yields on the back of the stronger news late last week, but yields actually remained steady and even backed off a bit in the UK and US early this week, so there's no immediate further driver from yields. The question becomes, is this part of some broader fundamental weakness that's showing up in things like that OECD global economic outlook and their trade numbers? And that pretty much does it for the short-term view of the S&P 500.